Hey everyone, it's John. It's time for a general market update. It is July 12th, 2024. Again, this presentation is for educational purposes, and we have a lengthy agenda. We're going to start with the fun stuff. Rain King Insights launch is here. The site is now live, and we're going to talk about how to get engaged. We'll go over the indices, breadth participation, rotation in the Fed, and then we'll look at the leader and some group action, and then we'll wrap up. So Rain King Insights, the website is now live. So I encourage you all to go to the website, www.rainkinginsights.com, and just have a look. The best way to do that, to take advantage of some early bird specials, is go to the early bird menu, open that up, and you'll get a page like this. The early bird window will go until July 21st, and you'll see this page, which scroll down because there's almost 9 blocks to look at. But a free membership, you need to sign up for a free membership, costs you nothing, but that gives you access to all the free content. And you can also see the discounts in the early bird window. The annual memberships are the ones eligible for discounts. You can see here the pricing here are the discounts already reflected, and take a look. So to get involved with the site, those of you that gave me your name and email on the pre-distribution list, you should have gotten an email earlier today. And you can just read this through. It has the some of the discounts off the regular pricing, talks about what comes in it, the live coaching huddles, as well as I would like you to go to the resources page and fill out the new member questionnaire if at all possible. That will give me a better sense of your experience and what you're looking to get out of the membership. And it will also give me your time zone, because I'm going to try and find time zones that are convenient for most people to be on the live calls, on the live huddles. So if we run into a glitch, just send me an email at support@rainkinginsights.com, and we'll get it fixed as soon as possible. Try to be patient. I'm only a one-person shop dealing with all the content plus the website. So, but we'll get it addressed quick as possible. And again, a reminder, you need a free membership in order to get access to all of this great material. And if you want to buy a report, a model book report. So the indices action, we're going to get into that next. Here's the NASDAQ composite, a chart cut at noontime today. What was really noticeable this past week was we were hitting new highs for almost 4 to 5 days in a row, as the index was really on low volume, really showing us that there wasn't a lot of enduring support to go higher. Things were starting to peter out. In addition to that, my pullback indicator was flagging that we were stretched and probably likely to come in. And yesterday, we certainly had a tough day in the Qs as there was rotation. On the positive side, if we look at the new highs and new lows, we have started to get above 50 new highs this week, which is encouraging. Also, yesterday, since it was a strong day, gave us net new highs above the level that we'd like to see, which is encouraging, but it's just a start. Hopefully, participation continues to grow and we get some rotations. So let's look at the breadth of the market, and particularly looking at the participation of stocks in the market. A month ago, I put out the New York Stock Exchange Advanced Decline chart, and I expressed the concerns about this divergence of prices moving higher with the breadth of the market, the AD line moving lower, and that this divergence could mean we need to have some time to correct in time or maybe in price. And we talked about some of the extensions and some of the exhaustion that we were seeing in the short term. We also reviewed the advanced decline line from the perspective as a long-term signpost. I've mentioned before, the advanced decline line is not a precise timing tool at all, because it could actually show divergences for months, could be 3 or 4 months or longer of divergences before you really see a top in the market. So we wanted to put it into context. Now, here is the updated NYSE advanced decline line as of yesterday. And what's noteworthy is as the market has moved higher, in the S&P in this case, you can see that the advanced decline line is starting to rally, showing us that maybe the breadth is actually turning up, and we're starting to get a more participation in the market, which is a positive sign. So it's a good clue. Also, for those of you who use the MACD, we're above the zero line and we got a bullish cross up, which is also encouraging that maybe we're going to see more participation in the market. Now, that being said, I did a little work this week. I dug up some data from macro charts, and we looked at a particular condition that is pretty rare in the market. And that condition is when you have a market, the S&P index, making new highs, and in conjunction with those new highs, we're seeing the percentage of stocks above their 50-day remain very, very low. In this case, low being below the 50 level. So let me break down this chart. The black line is the S&P 500 index. On the top panel, we have the percentage of stocks above the 50-day, and I've just drawn a black line at the 50 level. On the bottom of the chart is the NYSE new highs and new lows. So let's break this down a bit. In general, when we are in uptrends in the market, you will see primarily net new highs. You'll see green in the bottom panel. You'll see net new highs at a healthy rate, which is consistent with uptrends. In addition to that, you'll notice that the percentages of stocks above the 50-day typically stays above 50 as a minimum when we're in an uptrend. You can see this uptrend in 2020, 21, a lot of green on the new highs, and you can see the participation in the green is above 50. Now, when we go through corrective periods, you can see that the market becomes choppy. We start getting net new lows, evidenced by these pink zones, and you'll notice that the percentage of stocks above the 50-day goes below 50 and stays there. The rare condition is making new highs in the market, and we have the participation under the 50 level. So that's a very rare condition, and we'll look at it further. There really has only been 3 times that this has happened since 1990, June of 1998, December of 1999, and the most recent one was June of 2021, which I've shown below. So here you can see the S&P in black was moving higher to new highs in June of 2021, yet we had participation below 50 in terms of stocks above their 50-day moving average. Very rare. The market did move a little bit higher, but then it corrected. It still moved a little bit higher, then had a deeper correction. So there is certainly a caution sign when you see this signal. Now, you can see here, we are in the condition right now where we're making new highs in June and July in the index, but yet we're consistently below the participation level that we'd like to see. So that's something to keep in our back pocket. Now we put that information into the broader context, looking at sectors over the last 4 months, and it certainly weights things to the defensive side. You can see here, this is the IYT, this is the transports. They topped back in February and March and have been declining ever since. The relative strength line is really pathetic. The RSP, the equal weight RSP, topped in March, and the RS line is very poor. Then the industrials topped out in April, and you can see that. And you can also see the IWM topped out in April. Now we're going to talk about the IWM a little bit more in a little bit. So seeing all these sectors top out does not give us confidence about breadth. The Dow Jones also hit a peak in May and has been kind of trying to rally but going sideways. Now, probably the 2 sectors that are still leading the market are XLK and SMH, the semiconductor sector. But even the semiconductor sector, when it made a new high this week, the relative strength line did not confirm the new highs, and it got hit with some distribution yesterday, and the semiconductor index was off 3.6%, took on some distribution. So there's only a few sectors that are really leading. But what we're really interested in is, will there be rotations that support the breadth improving to build upon those incremental things I showed you in the earlier charts? So the rotation and Fed watch is our next topic. The Fed, if you look at the CME Fed watch, it's showing that after that favorable CPI report, the market seems to be optimistic that there's a 91% chance that we're going to get a rate cut in September, and additional rate cuts to follow in November, and an 87% chance of cuts in December. Now, today's PPI report was a little higher than expected, so a little bit of a cross current. The question is, what is the Fed going to do? And that really comes down to your confidence in the Fed. The Fed did not see inflation coming in 2021. What makes you think they're going to see inflation on the way out in 2024? So, what's your confidence level in that? The market certainly seems to be seeing a slowing economy and seems to be discounting the impacts of that slowing economy in some of the sectors, industrials, as well as we're going to look at some of the consumer sectors. Now, earnings season will be upon us shortly, and that might hold some insights of what companies say about the economy and what do they see for their guidance. So let's come back to a couple of key charts to watch as we look for potential rotations. Here's the Russell 2000, the IWM. Now, it's been really strong with this surge we've seen on the last 2 days. We've gotten 2 gaps up, and clearly those gaps are anticipating rate cuts coming fairly soon, because rate cuts would certainly benefit the small cap stocks. So that's encouraging. Now we want to see if we get some follow through. The IWM in the past has had some sharp rallies before, but they've petered out. Hopefully we'll see if this one has any legs. Other charts I think that are important to watch to really see if we're getting rotation to support this bull market are the QQQE, which we've been watching. We've been seeing this tightening that's been going on with smaller corrections and tightening, and we just started to break out this week. So that's encouraging. The relative strength line has at least started to turn up. We want to see if this continues to be strong, or if it flops over, things really would become much more negative. The equal weight S&P 500 here, you can see there's been a lot of tightening in the last month. In the last couple of days, we've had 2 gap ups showing that maybe there's rotation and breadth is improving, but it still hasn't broken out yet. So we'll keep an eye on that one. And the New York Composite, 3 very strong days, and we've cleared some resistance here, again, leading to that situation we're seeing the New York Stock Exchange advanced decline line improve, and hopefully confirming the new highs in the index, which would be really trying to resolve that divergence we talked about at the beginning of the video. Now let's look at the leader and some group action. So the leader of the market is NVIDIA. I mentioned in a post on X this week that I was really watching NVIDIA closely. It pulled back into the 20 and kind of stabilized. And then this week it's tried to rally. And I wanted to watch that rally, really see if it could actually move to new highs. And it got hit yesterday. We had some real rotation away from the AI trade and some of the big cap tech and semiconductors. So NVIDIA's pulled back down, kind of an inside day so far today. And this is very similar to what we saw in NVIDIA as a barometer for the market back in March, early April, when you had this big reversal day, and then it went sideways, and then we had a rally, but it fizzled out. And when it fizzled out, the market started to correct and go sideways. And you can see NVIDIA went sideways to actually have to build a base. So the current NVIDIA chart and the relative strength line here is the relative strength line is going sideways, probably meaning NVIDIA is going to bounce around and build more of a base in time versus price. So I think that's telling us that maybe our expectations are that we might need more time in the market. Now, the casual dining group, I think is important because it's a consumer group that really is suggesting right now that the economy must be weakening, because many of these casual dining stocks, which had been doing well, are all rolling over. Here's Chipotle, had this real fast run up of kind of an exhaustion gap up, run up right before the split. We got the split coming, and then right after the split, we've had really a lot of distribution occurring with the red spikes. So Chipotle has kind of unraveled here. Wingstop has also had 3 wide range red bars on increasing volume through the 50-day break, which is not great action. Domino's Pizza, similar, a 50-day break with some wide range down days is also negative, with the relative strength line really falling apart. Now, probably the number one leader in this casual dining area is Kava Group, and Kava's been the leader. And we can see here that even Kava has tried to break out to new highs one, two, three, at least three times, and it's been rejected all three times. And it's come in hard down into the 50-day, but so far it's had support at the 50-day moving average. So that's encouraging that maybe there's still some support for the leader, but it also probably means it needs to rest and round out this base that it started basically at the beginning of June. So we'll keep our eyes on Kava because it's a leading stock. So in summary, the indices have moved to new high, but on low volume. So that was a concern, and they were hit with distribution on Thursday. So we'll have to see if the market is going to correct further from here. The NASDAQ and the S&P are still above their 20-day, which really is still encouraging that they're still in uptrends. The new highs, new lows, we looked at this. We are seeing signs of improvement finally, and it's really leading us to the belief that maybe this rotation is going to improve the breadth and those divergences we saw for the last 4 to 6 weeks. Leading stocks, Thursday's rotation from large cap tech and the AI trade to these small caps and mid caps. The real question is this got any legs? Is it going to follow through? Are we going to get these rate cuts that seem to be being priced in September? 90% chance is a pretty high probability. If they don't happen, that could be a chance for the market to have to readjust. Can we avoid a deeper sell-off if there really is a weakening economy? Is the Fed too late to cut rates and the economy is just weakening in too rapid a pace? So that'll all be revealed to us in time. We just want to observe what's happening. Exposure levels, I've kept them exactly the way they are. They were slightly increased last week. I know I put on a few trades myself, very small pilots that were actually cut out and stopped for some very short, small paper cuts, but that's okay. We want to try and stay in sync with the market. So let's move the quote of the week. This comes from Barton Biggs, the former hedge fund manager who passed away, 12 years ago. He said, "A bull market is like sex. It feels best just before it ends." Now, the AI trade that's kind of melt up in the Qs, which was really going vertical, seems to have found its end, and we're going to correct a bit, which means semiconductors and maybe some other big tech names are going to cool off a bit. It was getting a little bit ahead of itself with the divergences that we were seeing. Very unusual period here, but that's our quote of the week. And that really is our general market update for the week, July 12th, 2024. Again, I encourage you to go to the new website, take a look, give me some feedback. We'll see how it goes. I'm going to give this a good run. I think I've got a lot of good material to share with people, and I'm interested in coaching and helping people really become better traders. So with that, we'll wrap it up, and I'll see you all next week.